Welcome to The Explainer. Today, we're unpacking launderers' biggest mistakes at 10 levels. It's essentially the ultimate cat and mouse game, right? We're tracking how dirty money desperately tries to become clean, and we're going to expose the fatal flaws built into every single step of that escalation. Okay, let's dive into this. Before we even hit level 1, we really need to answer a fundamental question. What is a launderer's absolute biggest mistake? Well, it boils down to a massive difference in mindset. Criminals, by their very nature, they tend to think in single transactions. They just want to get this batch of money from point A to point B, right now. But financial crime investigators, they don't look at single transactions. They look for patterns. And honestly, it's that inability to see the broader pattern they're leaving behind that traps launderers time and time again.
So let's start at level 1. I want you to put yourself in the shoes of the launderer for a second. Picture this. You've got $18,000 in dirty cash just sitting in a duffel bag. The absolute first rule you learn is you never deposit more than $10,000 at once, because that triggers an automatic currency transaction report to a federal database. There's no suspicion required, it's just an automatic flag. So you try a classic tactic called structuring. You split that $18,000 up, you deposit $9,900 at one branch on Tuesday, and then maybe $8,100 at a totally different branch on Thursday. You think you've outsmarted the system, but have you?
Yeah, no. Here is the Achilles heel of level 1. It's actually the easiest level to get caught at because of what we call the pattern trap. See, banks don't just watch for deposits over $10,000. They specifically watch for suspicious clusters of deposits sitting just under that limit. I mean, if a teller sees you bringing in $9,800 multiple times a week, they don't even need to prove the money is illegal. The pattern itself looks like it's designed to evade reporting, which is a federal crime all on its own. And today, compliance software at major banks automatically flags these structuring patterns across different branches in a way no human teller ever could. Boom, that triggers a suspicious activity report, or SAR, and just like that, small-time laundering ends right here. And this brilliantly illustrates why they have to move on to level 2, the cash business. To avoid those bank flags, they buy a classic cash-heavy operation. Like a laundromat. The whole goal is to mix your dirty cash with legitimate quarters coming in, artificially inflating your reported revenue. You gladly pay taxes on this fake extra income because, hey, it legally cleans the money. But here's the massive mistake launderers make at this level. They totally forget that investigators can check the math from the exact opposite direction. Say you claim your laundromat is doing $6,000 a week in business. Well, auditors are just going to look at your utility bills. If the amount of water and detergent you're buying would barely wash a dozen loads of laundry, you're going to have a really hard time explaining why your business is allegedly booming. That simple physical mismatch turns a completely routine tax audit into a major financial crimes investigation. Right, so a storefront can only process so much fake cash before it starts looking ridiculous. That means launderers eventually need to scale up to level 3, shell companies and fake invoices. This is where the whole concept of layering begins. You set up a company that literally only exists on paper. This shell company generates a fake invoice for, let's say, marketing services that never actually happened. Your legitimate-looking business pays that invoice, moving the money to a company that never has to prove it did any actual work. And to make it untraceable, launderers will bounce that money through maybe 6 different shell companies across 3 different states. But here's the catch. In isolation, a single fake invoice looks perfectly normal. The launderer's big mistake here is totally underestimating investigators. Financial detectives don't look at isolated invoices. They look for the connective tissue. Think about it. To build these complex networks, launderers have to rely on specialized accountants and lawyers. But if you look closely at how these networks operate, a dozen seemingly unrelated shell companies might all use the exact same mailbox service, the exact same accountant, or the same formation agent. These are structural fingerprints. This connective tissue is exactly what turns a bunch of scattered invoices into a fully prosecutable criminal network. Okay, so when fake invoices start getting too risky, launderers turn to level 4, real estate. And why real estate? Because property values are just incredibly subjective. So you buy a rundown property for $200,000 using some structured cash and a complicit lender. Fast forward a year later, you flip that exact same property to another shell company that you secretly control, but this time for $500,000. Because property valuation isn't an exact science, you now have a perfectly plausible on-paper cover for $300,000 of newly cleaned profit. We call this the subjective value trap, and honestly, it scales beautifully for the criminal. And for a long time, this was a massive blind spot. Real estate professionals historically faced far less anti-money laundering scrutiny than banks did. But the vulnerability here is that regulators are finally closing the gap. Many jurisdictions are now aggressively enforcing beneficial ownership disclosures. Basically, they're stripping away the anonymity. They are legally forcing buyers to reveal the actual breathing human being behind the shawl company. So that era of buying a luxury penthouse completely anonymously, it is rapidly coming to an end. Let's move to and see how this builds. Because as domestic regulators close in, launderers scale up to level 5, offshore structures. When authorities start connecting the dots at home, the operations get packed up and taken overseas to weak disclosure jurisdictions. The whole strategy is to hide that beneficial ownership through an absolute labyrinth. We're talking an offshore account held by a shell company, which is owned by a trust, which is administered by a local agent. And every single hop across a border requires investigators to wade through years of diplomatic and legal red tape just to get their hands on a single record. Sounds foolproof, right? Well, there is a colossal flaw at this level, and you won't find it in any regulatory playbook. It's the client list leak. See, thousands of these offshore structures are processed by the exact same handful of formation agents, and they're using identical paperwork templates. When major international journalism collaborations manage to get a leak of these documents, it exposes everything. I mean, they don't just find one suspicious transaction, they expose the entire client list and the entire infrastructure all at once. All that secrecy they paid so much for, it literally collapses overnight. Now, what's really interesting about this slide is how it illustrates level 6, trade-based laundering. Regulators often call this the absolute hardest method to detect because it hides right in plain sight inside legitimate international commerce. Imagine you ship a container of perfectly ordinary furniture across a border, but you artificially inflate the invoice. The importing company pays that inflated price, and the extra money is your laundered cash. But notice the vulnerability in this data. If you repeatedly claim your ordinary furniture is worth $185,000, while literally everyone else's is going for $12,000, you create a massive statistical outlier. Customs agencies use data analytics to compare declared prices against global databases. Systematic over-invoicing leaves this glaring mathematical pattern that algorithms are perfectly designed to catch. Moving right along, level 7 takes us straight into the digital age, the cryptocurrency illusion. Here, launderers try to exploit a financial system that's still kind of catching up to the tech. They use these services called cryptocurrency mixers or tumblers. The idea sounds pretty slick. You throw your dirty crypto into a giant digital pool with everyone else's, and an equivalent amount gets spat back out to a new wallet, effectively breaking the direct link between the deposit and the withdrawal. But this relies on a fundamental misunderstanding of the technology itself. The ultimate mistake here is forgetting that the blockchain is literally a permanent, publicly visible ledger. It never forgets. Law enforcement agencies use incredibly sophisticated forensic tools to analyze timing patterns and clustering behavior. And here's the kicker. If an international task force raids and seizes one of these mixing services and gets their hands on the transaction logs, years of supposedly anonymous transactions are retroactively unmixed in a single stroke. That anonymity, it was only ever temporary. Now, at level 8, we aren't talking about duffel bags anymore. We're talking about billions of dollars moving globally. This is correspondent banking. Basically, a bank in one country processes transactions for a bank in another. The vulnerability here isn't the transaction itself, it's the reliance on institutional failure. Launderers exploit under-resourced bank compliance cultures, the ones that prioritize processing volume over flagging suspicious activity. The fatal mistake they make is assuming this institutional blindness will last forever. Eventually, external pressure forces a routine regulatory compliance review, and the sheer volume of unexplained money brings the whole house of cards crashing down. This is exactly what results in some of the largest fines in financial history. So, the crucial point is this ultimate vulnerability at level 9. Across all these methods we've talked about, from real estate to offshore trusts to global banking, the biggest mistake a launderer makes isn't financial, it's human. Behind every major prosecution is a real person. It's the passed-over employee in the compliance department. It's the nervous accountant keeping an extra set of books. It's the uneasy registered agent who finally decides, you know what, they can't stay quiet anymore. A single motivated insider, often incentivized by whistleblower reward programs, by the way, can hand investigators the exact keys to a network that external forensic accountants could have spent decades trying to crack. Which brings us to level 10, how it all unravels. The ultimate flaw in money laundering is that money, no matter how dirty, eventually has to explain itself to some institution in some jurisdiction. And every single time it does, a cross-border wire, a suspicious activity report, a customs declaration, it leaves a permanent data point. Financial intelligence units like FinCEN here in the US exist for basically one reason: to aggregate these exact data points.
An isolated shell company invoice means nothing on its own, but cross-referenced against 40 other flagged transactions across multiple countries over several years, those isolated dots are aggregated into a straight line, connecting exactly where the dirty money started to exactly where it ended up.
So, this leaves us with a final provocative thought. Every single layer a launderer adds, the structuring, the shell companies, the mixers, it's all just designed to multiply the labor for investigators. But the system doesn't fail because the tools to trace the money don't exist. It fails only when investigators run out of time, resources, or political willpower before the statute of limitations kicks in. But the trail is permanent. The pattern is always there, just waiting to be found. So how long can a paper trail truly stay hidden before a single pattern or a single insider reveals the whole thing? Thanks for joining me for this explainer. If this changed how you think about where dirty money actually goes, let me know what complex topic we should break down next.